In the realm of U.S. economic indicators, a nuanced scenario unfolds as inflation in the United States exhibits a divergence between headline and core metrics, influencing the Federal Reserve's contemplation of future monetary policy adjustments. The latest data reveals an acceleration in headline inflation during December, potentially complicating the Fed's timeline for policy easing. However, a contrasting trend is observed in core inflation, where a continued deceleration implies a more favorable underlying trajectory. Let's delve into the specifics of the report. For December, the U.S. Consumer Price Index, CPI, marked a 3.4% increase from the previous year, surpassing November's 3.1% and representing the highest annual rate in 3 months. Monthly, prices saw a 0.3% uptick, the most substantial rise in 3 months. However, when isolating volatile food and energy prices, the core inflation picture emerges. Core prices registered a 3.9% increase in December from a year earlier, slightly down from the 4% recorded in the previous month. More notably, this signifies the lowest core inflation rate since May 2021, with a 0.3% increase from the previous month. Within the inflation landscape, shelter emerged as a prominent contributor, with prices soaring by 6.2%, constituting about 35% of the Consumer Price Index. Excluding shelter, the year-over-year price increase in December was a modest 1.9%. Notably, there are indications that shelter price inflation might witness a slowdown in the upcoming year, as it is influenced by house prices with a lag. Despite a relatively stagnant year for house prices, expectations are that this will influence the shelter component of the CPI, contributing to potential inflation alleviation. The sectoral breakdown unveils a decline in durable goods prices by 1.2% in December from a year earlier, while non-durable goods prices increased by 1.8%, primarily driven by a 2.7% rise in food prices. Excluding food, non-durable goods saw a more subdued 0.8% increase. Service prices demonstrated a 5% rise, propelled by shelter, while excluding shelter, service prices increased by a more moderate 3.4%. One key concern for the Federal Reserve revolves around the labor market, where rising wages at an annual rate of over 4% pose a challenge in achieving the 2% inflation target. This concern steers the Fed's intent to maintain high interest rates for an extended period to counterbalance wage pressures. Despite the potential impact of the inflation report on the Fed's policy stance, a counterbalancing factor arises from the news of a decline in producer prices during December. This is a significant development, given the influence of producer prices on consumer prices. A third consecutive monthly decline was observed, with final prices of producer goods and services falling by 0.1%. Notably, this decline in producer prices suggests a potential reduction in consumer price inflation, reinforcing expectations of future monetary policy easing. Before we move on to the market, please click like and subscribe to our channel. This will really help us a lot, and we owe it all to you. Thank you. Shifting the focus to the U.S. labor market, the recent government report indicates that the job market remains robust, with 202,000 initial claims for unemployment insurance last week. The relatively low number signifies a tight job market, affirming the strong performance of the U.S. job market throughout much of 2023, outpacing modest expectations amid Federal Reserve monetary tightening. The dichotomy between a favorable jobs report and signals of economic weakness, as indicated by the ISM's Purchasing Managers' Index, PMI, for services, has left investors in a state of uncertainty. Examining the job market details reveals a notable creation of 216,000 jobs in December, making it the largest gain in 3 months. Industry-wise, sectors such as construction, retail, professional services, healthcare, leisure and hospitality, and local government experienced strong employment growth. Conversely, manufacturing, mining, transportation and warehousing, financial services, and federal and state government witnessed weak or negative job growth. The divergence in bond yields following the release of jobs data underscores the conflicting sentiments among investors regarding the economy's direction. Wage behavior analysis from the Establishment Survey indicates a 4.1% year-over-year increase in average hourly earnings for private sector workers in December, up from 4.0% in November. Although wage growth had been decelerating, recent months have witnessed relative stability around the 4% mark. This persistent wage growth remains a principal concern for the Federal Reserve, prompting its commitment to keeping interest rates high to mitigate inflationary pressures. While the separate household survey highlights a decline in labor force participation in December, resulting in a steady unemployment rate of 3.7%, caution is advised due to the inherent volatility of household survey data. The overall investor sentiment, initially buoyed by a favorable jobs report, turned cautious with the ISM Services PMI revealing unexpected weakness in service sector growth. Investors grapple with conflicting signals, leaving them uncertain about the economy's trajectory. In addition to the employment report, attention is drawn to two critical job-related data releases: initial claims for unemployment insurance and the Job Openings and Labor Turnover Survey, JOLTS. The 202,000 initial claims indicate a relatively tight labor market, while the job openings rate remaining unchanged at 5.3% suggests a persistent but somewhat loosened labor market compared to pre-pandemic levels. Turning to the Federal Reserve's perspective, the minutes from its last policy committee meeting shed light on the committee's intention to keep interest rates high for an extended period. Despite futures markets pricing in the possibility of a rate cut in March, the minutes reflect a cautious optimism. The labor market is observed to be gradually aligning labor demand and supply, potentially reducing wage pressures. However, concerns linger about credit market conditions, with some sectors experiencing deteriorating credit quality. The minutes convey an expectation of GDP growth cooling in 2024 and lower inflation compared to 2023. The balance of risk between inflation and unemployment is deemed roughly even, signaling a nuanced approach to future policy adjustments. The Fed acknowledges progress but remains cautious, anticipating policy easing later in the year while ensuring a measured response to evolving economic conditions. On the consumer sentiment front, December witnessed a notable rise in consumer confidence indices from both the Conference Board and the University of Michigan. This positive shift aligns consumer perceptions more closely with economic realities. The Conference Board's index surged from 101.0 to 110.7, attributed to improved perceptions of business conditions and reduced pessimism about the labor market. The University of Michigan's Consumer Confidence Index rose from 61.3 to 69.7, primarily driven by improved perceptions of inflation and the business climate. While not a direct predictor of consumer behavior, the improved sentiment sets the stage for continued consumer spending growth. In conclusion, the intricate dance between various economic indicators and market sentiments underscores the complexity of the current economic landscape. As the Federal Reserve carefully navigates potential policy adjustments, investors remain vigilant, interpreting signals from inflation, employment, and consumer sentiment to gauge the path ahead for the U.S. economy.